Sunday, April 5th, 2026. Like and subscribe, The $1 Investor. 7th ETF, 7th day. Another daily recurring purchased ETF that I buy daily, and its 5-year outlook. Here is a complete breakdown of the ETF Crane Shares CSI China Internet ETF, KWEB, and I'm going to explain the last 5 years and the next 5 years outlook. 1. What KWEB actually is. KWEB is the Chinese internet companies ETF, basically China's version of US tech companies. It holds companies like Tencent, China's Facebook plus gaming, Alibaba, China's Amazon, JD.com, China's e-commerce, Baidu, China's Google, Meituan, China's DoorDash plus Yelp, PDD, Temu owner. This ETF is pure China tech internet, not banks, not oil, not factories. Expense ratio, 0.70%, a bit high but normal for international thematic ETFs. Like and subscribe, The $1 Investor. 2. Breakdown of holdings and sectors. Top holdings, 62% of the ETF. Company, weight percentage, Tencent, 10.17%. Alibaba 9%. PDD 8.59%. Meituan 7.14%. NetEase 6%. JD.com 4.81%. Baidu 4.36%. KE Holdings 4.35%. These top companies make up over 60% of the ETF. So this ETF basically moves based on Tencent plus Alibaba plus PDD plus Meituan. Sector breakdown. Sector. Percentage. Communication services, 40.61%. Consumer cyclical, 37.73%. Healthcare, 7.35%. Real estate, 4.36%. Consumer defensive, 4.36%. Technology, 3.51%. Financials, 2.08%. So this ETF is mostly social media, online shopping, gaming, delivery apps, internet services. This is not traditional tech like Apple, Microsoft. This is internet platforms. 3. What it did the last 5 years, important. This part is very important. 5-year return, about minus 63%, yes, negative. Average return since start, 2.46% per year. Why it crashed? China did 3 big things. 1. Government cracked down on tech companies. 2. Alibaba got fined. 3. China economy slowed. 4. COVID lockdowns. 5. Companies delisted fears from US. So from 2021 to 2024, this ETF got destroyed. But recently, Tencent earnings strong, Alibaba improving, China stimulus money, interest rates falling, Temu, PDD growing fast. So sentiment is improving again. 4. What Wall Street thinks, next 5 years. This is the important part, the future. Bull case, if China economy recovers. Analysts think China tech is undervalued, PE ratio around 15, cheap compared to US tech. Government is now supporting tech again, could grow 8 to 15% per year, bear case, risk. Chinese government regulation, Taiwan conflict risk, US-China tensions, accounting transparency concerns most realistic expectation, Wall Street expectation long-term, 6%, 10% average annual return if China stabilizes. Not guaranteed, but that's the general outlook. 5. Your strategy, $1 per day. You said, $1 per day, 5 days per week, 20 years. That equals $5 a week equals $260 a year. 20 years equals $5,200 invested. If KWEB averages, 6% turns into $9,600. 8% turns into $12,000. 10% turns into $16,500. 12% turns into $22,000. So my $1 a day could turn into $10,000 to $20,000 long term. That's the power of consistent investing. 6. Important truth about KWEB. This ETF is high risk, high volatility, emerging markets, political risk, but high growth potential. This is not a safe ETF like S&P 500. This is a long-term bet on China technology. My $1 a day China investment plan. I started investing in 1997. Back then I didn't have much money, but I had something more important, time. Over the years I learned something very important. It's not about timing the market, It's about time in the market. Today I'm investing in something called KWEB. It's an ETF that invests in China's biggest internet companies. Companies like Alibaba, Tencent, JD.com, Baidu, companies that power online shopping, gaming, delivery apps, and technology in China. Now I know this investment is not safe. It goes up and down, a lot. But I'm not investing for 1 year. I'm investing for 20 years. My plan is simple. I invest $1 a day, 5 days a week, every month, every year. That's only $5 a week. Most people spend that on coffee, but over 20 years, that small investment can turn into $10,000, $15,000, maybe even $20,000. Not because I'm smart, not because I can predict the market, but because I am consistent. I've been doing this since 1997, and what I learned is this. The market rewards patience. The market rewards discipline. The market rewards people who don't quit. So this is my journey. $1 at a time, 1 week at a time, 1 year at a time. I'm not trying to get rich quick. I'm trying to get rich slow, because slow money lasts, fast money disappears. And 20 years from now, my future self is going to thank me for what I'm doing today. Make me proud. Final opinion, my advisor opinion. If this was a portfolio strategy, S&P 500, safe growth, KWEB, aggressive growth, dividend ETF, income, bonds, stability, KWEB should be maybe 5 to 15% of a portfolio, not everything. But as a $1 a day long-term play, I actually like that strategy because I'm dollar cost averaging into a volatile asset. That's smart. Like and subscribe. The $1 Investor.